The Japanese yen is the third most traded currency in the world, and one institution controls its direction more than any other: the Bank of Japan, known as the BOJ. If you trade any yen pair, you need to understand how this bank operates. The BOJ was founded in 1882. It is Japan's central bank, which means it manages the country's monetary policy, issues currency, and works to keep the financial system stable. Every major economy has a central bank. What makes the BOJ different is the unusual position Japan has been in for decades. Most economies fight inflation, rising prices. Japan has spent years fighting the opposite problem: deflation, which is falling prices. That distinction pushed the BOJ to try policies that most other central banks never attempted. For many years, the BOJ held interest rates at or near zero. Then in 2016, it went even further and introduced negative interest rates, effectively charging commercial banks a fee for holding excess reserves. The goal was to push banks to lend money rather than sit on it. The BOJ also introduced something called yield curve control in 2016. Under this policy, the bank targets specific levels for long-term government bond yields and buys or sells bonds to keep yields within a set range. This directly shapes borrowing costs across Japan and sends clear signals to currency markets about where the yen may be headed. For traders, the practical takeaway is this: low interest rates make the yen less attractive to investors seeking returns. That keeps persistent downward pressure on the currency. When the BOJ signals any shift toward tighter policy, the yen can move sharply and fast. The BOJ holds policy meetings roughly 8 times per year. Those meetings move markets. Watch the rate decision, then watch the governor's press conference closely. That is often where the real signals are buried. Japan also has a history of direct currency intervention. In 2022, authorities stepped in to support the yen when it fell to its weakest level against the dollar in around 32 years. These interventions are rare, but when they happen, the moves are dramatic. One more concept worth knowing: the yen carry trade. This is where traders borrow in yen at low interest rates and invest in higher-yielding currencies elsewhere. It is a popular strategy, but when market conditions shift or the BOJ signals rate hikes, carry trades unwind fast. That can send the yen surging in a very short window and catch unprepared traders badly offside. If you want to trade yen pairs, build a habit of tracking BOJ rate decisions, the quarterly outlook report, Japanese inflation data, and any statements from the Ministry of Finance around currency levels. A good economic calendar on your trading platform will flag these in advance. Use it.